No lift. It's not a powerlifting meet, it's the RBA. Hi everyone, welcome to the weekly market update. Today is Tuesday the 4th of July, Independence Day for the Yanks. And just before I get into it, if you enjoy the content, please click the subscribe button. It really helps us out a lot. And also, you need to be aware that anything I say is general advice only. So it doesn't consider your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. So today was RBA day, RBA rate decision day, and they left rates on hold at 4.1%, left them unchanged. So in the statement, they basically acknowledged that inflation was still high, that they may have to lift rates further, but they did say that things are starting to look a little better from an inflationary perspective. So they pointed to, headline inflation coming down. They pointed to, stress from Australians out there, particularly from mortgage holders. And, they sort of alluded to the delay between monetary policy and actual economic changes. In reality, the statement didn't really hold much substance. Basically the only thing of note was the fact they didn't lift interest rates. And they really left everything else sort of to be determined by future data and at future meetings. Ultimately, this was quite a surprise, I think, to myself. Quite a surprise to some in the market. I think it was pretty 50-50 as to whether they didn't lift or did lift. It comes after a series of 50-50 decisions where they did lift the last couple. And so maybe, third time's the charm. They decided to wait and see. Ultimately, though, I'm not sure if that was the right decision. I do think there is a big risk that, by dragging out the interest rate rises, we end up with a longer period of higher rates and perhaps even a higher terminal rate than if they nip things at the bud. When we look at inflation, it's not just about, the absolute level of interest rates in determining what inflation is. In fact, the research out there suggests that there's a lot more factors at play, particularly things like inflationary expectations. And, if you go hard and you lift hard and you sort of hammer into it, you might be able to sort of weaken those inflationary expectations. But by sort of going slow and sort of, keep chipping at it, inflationary expectations remain high. And if we look at things like the energy generation and wholesale sectors and the insurance sectors, there have been several updates from companies in those sectors recently where they've been able to increase their prices due to inflationary expectations, not necessarily because costs are going up for them. And it's a similar story in things like the supermarkets. They've been able to increase their margins because consumers are expecting higher prices. So I did want to sort of touch on that. I'm not sure ultimately this was the right move in the battle against inflation, at least from a longer term perspective. Yes, it was great for the market in the short term. Yes, it's great for mortgage holders in the short term. I'm a mortgage holder myself, and obviously I don't want to see heaps of rate rises. And the fact that we haven't had one today perhaps could be seen as a small victory. But from a longer term perspective, I do worry that it basically drags out the battle. It drags out the period where we have higher interest rates. And, people think that we've got inflation, and that means people can keep lifting prices because that's the expectation. And it becomes an expectation cycle as opposed to, a cost pressure cycle. And so I'm not sure this was the right move in the battle against inflation. If you've watched my videos, I've been fairly hawkish regardless. Ultimately, only time will tell. And to be fair to the RBA, there definitely are cracks starting to appear. So there was a Roy Morgan ANZ mortgage stress survey. I think it came out this morning, some articles in the AFR. And they basically said that almost 30% of borrowers, mortgage holders, are in mortgage stress already. Now, if they were to lift further, obviously that's going to increase further. So it is starting to affect people. It is starting to affect spending decisions. I mean, we've seen the recent retail sales numbers. People definitely sort of concentrating on spending more on the things they need to buy, not necessarily, the things that they want to buy. Similarly, in the price numbers, it wasn't the prices of discretionary goods or big electronic items or things like that. That wasn't the stuff that went up in price. It was food, it was staples, it was services, insurance and financial services, things like that. that went up in price. And it's not the stuff people want to buy, but the things that they have to buy. And so, look, ultimately, I'm not sure if the hold here was the right decision. Like I said, time will tell. I do think the RBA is behind the curve in their battle. It seems like they're being very reactionary, very reactive to what's going on in Australia and around the world. And I'd like to contrast that with the US, where, I think the Federal Reserve has room to play with. They've been very clear with what they're going to do. They've rapidly lifted interest rates. They're at 5.5%, a lot higher than we are now, and likely to go 2 more. And they've been pretty clear that it's probably going to be 2 more. The market knows what to expect there. Whereas here in Australia, it seems, every rate decision we have is, will they or won't they? And the RBA hasn't been very clear with their messaging, and it doesn't create a situation where people are confident prices are going to come back down. And that goes back to that inflationary expectation thing I was harping on about. People have to be confident that prices are going to come back down. They have to be confident the RBA is going to be strong, going to go hard, and otherwise it becomes a very, very drawn-out battle. So look, like I said, time will tell if it's the right move. We're going to have to see how the data comes out throughout the next few weeks. Wouldn't be surprised at all to see a rate rise in August now. I think it's almost guaranteed unless the data really looks deflationary from here, and I'm not sure that's going to be the case. We're going to see some retail sales data tomorrow. There's going to be a lot more data to come out. We're looking particularly at things like price data, employment data, and sales data as well. And after a hold this month, I think very, very likely to see a rise in August. So I've been talking a lot about Australia and the battle we have with inflation and interest rates. It's a battle going on all around the world. A battle that appears to be being won in the US. Their CPI growth, their price growth is definitely coming down a lot quicker than our own. Like I said, their Federal Reserve a lot higher on the interest rate curve already. Things are a lot tighter over there. And I guess one more positive from the US is, while they've been able to slow the rate of CPI growth or slow the rate of inflation, the economic data is actually remaining fairly strong. So a few months ago, 3 months ago, everyone would have said guaranteed US recession by the end of the year, starting next year. And now it looks like they may be able to achieve a soft landing. The data is remaining strong while the price growth is slowing. So really positive situation in the US, definitely less positive in the UK. Their CPI is still very high, but their economy definitely slowing from a very slow level already. Europe's a bit of a mixed bag. So it's a bit of a mixed bag around the world, but I would like to just highlight that things in the US are going a lot better than they are here, and that's reflected in their equity market. So it is very common for Australian investors to look at US equities and basically say, well, they've been on a very strong uptrend for the past 3 months, just set a 16-month high roughly, testing new highs again overnight in a shortened trading session, and our market should be rising. Look at the strength they're having there. But like I said, it's a different economic situation. Their Fed's been able to get a handle on inflation better than our RBA has, at least so far, and they've been able to do it without causing too much economic damage. So, in that situation, the US market does see a potential peak in interest rates in the coming months, and they see that peak being achieved without a potential recession. And that's why they've had a stellar 3 months, and that's why they're testing that 16-month high. They will be closed tonight for the Independence Day public holiday, and they will reopen tomorrow night, but I wouldn't be surprised to see them hold at that technical resistance, just given the extreme strength they've had. If they do hold and show a bearish signal, we'd be looking for a move back to potentially 4,300 on the S&P, or maybe a little bit above that to come and find this uptrend line here. So by the time they reach that trend line, it might be 43.20, it might be 43.50, and then I'd suggest most likely a rebound off that level. Going into the second half of the year, their shares do look quite expensive relative to other asset classes out there. If you consider bond prices here, from a risk-adjusted return perspective, you have to say they do look attractive relative to equities, or at least you could say equities look relatively expensive in the US, and that's despite that positive economic outlook. So just something to keep in mind in the second half of the year, but regardless, definitely some positive momentum in US markets. For our own XJO, the top 200 stocks here, we're sitting in much more in no man's land. We had a bit of a break higher, but held resistance at 73.70, a break lower, but held support at 7,080, and we've rebounded to maybe 7,300. We've held below that level today. The market did jump on the fact that the RBA didn't cut rate, or sorry, didn't lift rates, I should say, but I'm not sure that optimism is going to be sustained too much. If we are to head higher, we'll have to close above 7,300, and then the next resistance, like I said, not too far away at 7,370. That would have to break before we look likely to go back to 75.50-ish. If we fall from here, recent lows at 70.80 are the levels that I'd be watching, and to be honest, I think that's somewhat likely. If we see a pullback in the US, given that they're at a key resistance after a big jump, it is somewhat likely we'll see a move back towards 7,100, 70.80. And that's despite the optimism from the hold from the RBA today. So guys, will this just push out the rate rise timetable? Will this lead to higher for longer interest rates? Or is this the first sign that we're going to see a peak in rates in the not too distant future? Like I said, time will tell, the data will tell. I'm a little skeptical, as you can probably tell if you've watched this video so far, but only time will tell. So guys, if you have an opinion, put it in the comments below. Click the like button if you enjoyed the video. If you didn't, click it anyway, and I'll see you guys in the next one. Bye for now.